Hello everyone and welcome to another video for CFA Level 1. In today's video, what we will be doing is continuing our previous discussion on firms and market structure. In the previous video, we had completed everything which was to study with demand. In today's class, we will study everything which is related to supply. And just one more thing, after today's class, we will be completing the initial or the introductory portion of the reading, and then we will be starting with the market structures as such. Okay, so before the market structure, this is the last topic that we will be doing. Again, if you look at the material, they have given concept related to supply and directly deep dived into some other discrete topics. But what we will do is that first we will understand the definition of supply, what is definition of supply, and then we will get into the aspects which are there in your curriculum. Okay, so like demand, we will also define supply. What is supply? Supply is also very simple. Supply is defined in three broad terms. Okay, willingness, ability at a particular price, and specified period of time. Okay, so what is supply saying? That supply is saying the quantity of goods and services a producer. Who is a producer? A producer is something who is supplying goods and services in the market. So what is supply? A supply means a quantity of goods and services that a producer is willing to supply. Producer is willing to supply at a particular price and is also able to supply it within a specified period of time. Okay, so first over here we are clearly given that supply is determined with respect to price. Okay, very important statement. Okay, this statement will not only help you over here but also in further economic concepts. So supply is always defined with respect to price. Okay, so at different level of prices the supply will be different. Okay, second, supply is always considered in a specified time period. In a specified time period. Okay, supply is always considered in a specified time period. Why? Because if you take a longer time duration, okay, then you can always increase the quantity of goods or services that can be provided, and thus in order to define a particular quantity we are also required to define a particular time period. Third, and the most important, there should be willingness and ability to provide goods and services. So willingness as well as ability is important. So for example, let us take commodity X. Okay, suppose we define the price as $1. As a producer, suppose the cost to me for production is 50 cents, then I will be very happy selling it to you at $1. Okay, so my willingness is high because I am making a good profit. But then the second question is, what is my ability? Okay, now what does ability means? Ability means over here is the production capacity. Although I would love to supply you the goods at $1 because I am making a good profit, But if I am not in a situation to produce it, then I will not be able to provide it to you. Am I right? Since I am making a lot of money, I want to supply it to you. So my willingness is high. My willingness is high. But I don't have the capacity. I don't have the production facility to provide it to you. So my ability is not there. So lower of willingness and ability is the amount which will qualify for supply. Sometimes my willingness might be low, ability might be high. When, for example, if the price of the goods is $0.6 and I am preparing it for zero point 0.5. Suppose I have a large manufacturing ability or I have the large production capacity, but my willingness is low. I don't want to produce at that. I don't want to produce and sell at those prices. So my willingness is low. Over here, my ability is high. But if I'm making a good profit, my ability will be low and the willingness will be high. Okay. So we need to see what is lower, willingness and ability. The one which is lower will actually quantify my supply. Are we clear? Now, how do we determine? So over here we have seen what is supply, willingness, ability at a particular price within a specified period of time. Guys, it is very important that you understand the definition of supply, because it will be used in a lot of other concepts as well, whenever you are doing market structure also. So demand and supply is something you should be very clear what does it mean. Okay. Now we come to another important aspect, production capacity. How is production capacity determined? Production capacity is determined or is said to be based on factors of production. So production capacity is based on factors of production. What are factors of production? Factors of production are those things which enable a production of goods or services, which enable production. Okay. And now what we will study is as per economics. So as per economics, there are four factors of production. As per economics, there are four factors of production. Okay. The first one is the labor. Who is a labor? A labor is a person who will work on the machines in order to get the produce. Guys, are we getting it? Second is the material. Material, we all know the raw material which will get into the production process in order to, so that we get the output. Guys, are we getting it? What is material? Guys, are we getting it? What is material? Material is the things which are going into the production so that we can get the output. The third is the capital. What is capital? Capital can be physical or financial. What is financial? Financial is money. Yes. Without money, how will you engage in the production process? So you need money. And physical is machine and all. Correct? Because you will not produce everything by hand. You will need machines in the process. And the fourth is land. Definitely land is needed. Where will the machine sit on? Where will the workers sit on? Where will the process happen? It will happen on land. So these are the four factors based on which production is determined. And based on this factor, since the production is determined, we can say that this is the deciding factor for total output. Correct? What is total output? Total output is nothing but quantity produced. Yes or no? Can we say that? Yes. Now, an important thing that we need to see over here. Okay. See, the first two that we have seen are variable factors, and the second and the third and the fourth are considered as fixed. And these are considered variable and fixed. This this classification of variable slash fixed is for short period of time. Correct. So when we break the time period as short and long, in long run, all these factors of production are considered as variable. But when we are considering in short term, material and labor is considered as variable. Land and capital is considered as fixed. What is fixed? Fixed and variable. So fixed is the fixed factors of production are those. So fixed. They are those whose or supply or quantity remains unchanged in short period. Remains unchanged. So what will happen? In short run, irrespective of the kind of demand that you have for the product which you are producing or which you are supplying, you will neither be able to increase the land or you will neither be able to increase the capital. Their supply is limited to what is given. Variable one whose supply changes. One whose supply changes. So what does it mean? It means that depending upon the demand for the product that we are offering in the market, a producer will be able to change the amount of labor and material that he is giving into the system. So fixed are those whose supply cannot be changed. Variable are those whose supply can be changed in short run. Okay, supply changes. Guys, are we clear? Guys, are we clear with the definition of supply? And then are we clear how a production is determined? Okay. See over here, we have already covered one part when we were doing it. Factors of production, resources a firm need to generate output, land, labor, capital and material. What is land? Where the business facility is located, labor, all workers. Capital can be physical and financial. We have already seen over here. Capital is physical and financial, and material is input in the production process. Guys, are we clear? Guys, are we clear with the basics around supply? What does supply means? What is production capacity? What are the factors of production? Guys, are we clear? Now what we will do is we will understand one more concept, and this concept is known as total return and marginal return. Total return and marginal return. What is total return? Or output. It is the total quantity of products produced by the producer. Okay. What is marginal output? See, marginal, the name specifies additional quantity of product produced by providing. Now, this is an important aspect. By providing one additional unit of labor. So what we are doing, we are providing one additional unit of labor. See, this is the catchphrase, one additional unit of labor, keeping the fixed factors unchanged. So what we are doing, we are seeing by just increasing the labor, and over here we can increase the labor. We have already studied, right? Labor can be increased. We have seen labor can be increased in short run as well. But what cannot be changed? Land and capital cannot be changed. They are known as fixed. So we are keeping fixed factors. What is fixed factors over here? What are fixed factors? Fixed factors are nothing but land, capital. So land and capital is unchanged. Labor is increased. So what is the additional unit that I can get? That is marginal returns. Okay. Now there is a law associated with it. Law associated with marginal returns. And this law, if you have understood in principle, this will apply throughout your reading. Okay, and it will apply in a lot of other readings as well. Okay, law associated with marginal return, which is diminishing marginal returns. Which is diminishing marginal returns. Are we clear? Okay. Now let us study what it is saying. So diminishing marginal returns. Over here we have expressed it in graphical manner, but we will definitely write what it means. So let us write and then we will see what does the graph says. Okay. Law of diminishing marginal returns provide that when additional labor is deployed, the production initially increases at increasing rate, then increases at increasing at decreasing rate, and then starts to decrease. So what did we say? We said that when your fixed factors are fixed remaining unchanged and you are adding one additional labor, initially your marginal returns will increase at an increasing rate, then it will increase at a decreasing rate, and then it will eventually start to fall. Guys, let us see with the help of a diagram. What we are doing is that in this diagram, we will have the output on the y-axis. Why? Because this is nothing but indicating returns, correct? In the x-axis, what we will have? In the x-axis, we will have labor. Why? Because this is the input being increased. Okay. Now what we are doing, capital is assumed to be fixed. Clearly it is given in the law of diminishing return. So what we are happening, we are seeing three phases over here. First, increasing at an increasing rate. Second, increasing at a decreasing rate. And third, decreasing. So the first phase is this, where marginal return is increasing at an increasing rate. Then comes the phase of diminishing return, where it is increasing, but it is decreasing. Okay, and then it is coming eventually coming to negative. So basically, at this point, a producer will say, okay, there is no point of adding further labor. Why? Because any additional labor that I am providing, it is not giving me any additional output. So producer will say, okay, beyond this, there is no point of putting additional labor. Guys, are we clear? So this is how the nature of production works in short period of time. This is known as law of diminishing returns, diminishing marginal returns, and this is very common in your exam. So guys, please be very sure of the concept. Please be very confident of the graph, because anything can come. Okay, you might be given a question in which you will be given 5-6 calculation of output, and then you will be asked from which output to which output, what is the phase. So this is phase 1, increasing return, phase 2, decreasing return, and phase 3, negative returns. So you will be asked that from which output to which output you were in phase 1, from which output to which output you were in phase 2, from which output to which output you are in phase 3. Guys, are you getting it? Okay. Now we come to again another important aspect related to supply, and it is the last concept, is economies and diseconomies of scale. Economies and diseconomies of scale. What is economies and diseconomies of scale? Economies of scale is a concept which says that when you are increasing your output, economies of scale is a concept which says that when you are increasing your output, the cost per unit will come down. Okay, so what it is saying is that economies of scale is saying that when output is increased, okay, you are increasing the output, okay, obviously your total cost will increase. Okay, total cost increase, this is obvious, this is obvious. Okay, but what will happen, the cost per unit will fall. Okay, when your output is increased, your total cost will increase. That is obvious, means that is not even a question. but your cost per unit will fall. This phenomenon this phenomenon is called as this phenomenon is called as economies of scale. Now there is one more hack to it. It further says that beyond a point, beyond a point, your cost per unit will start to rise. So initially when you are increasing the production, your average cost or cost per unit is coming down. Okay. You reach a point, and after that point, even if you are increasing the output, your cost per unit is coming up. Why? This usually happens because inefficiencies of system kicks in. Earlier, suppose if you have one factory, you as a person can stay in that factory, monitor the entire process. You can expand that factory to increase the output. Suppose further expansion is not possible and you have to take another factory. Now you have two factories, correct? You cannot be there at the same time in both the factories. So there might be inefficiencies in the other factory, because of which your average cost per unit might go up. So what it says that beyond a point of output, inefficiencies in the system become so dominant, so powerful, that your average cost per unit rises. And that is known as diseconomies of scale. Guys, are we understanding? Did we understand economies of scale and diseconomies of scale? So what is economies of scale is saying that when you increase the output, total cost will definitely increase, but average cost or cost per unit will fall. Beyond a point, inefficiencies will come in and your cost per unit will start to rise. This is known as economies of scale and diseconomies of scale. Okay, let us see what it is. So this is the graph. In the y-axis we have cost. So this is cost per unit. In the x-axis we have output. This is total. Okay, this phase that we are seeing in the left, okay, the phase which I'm marking with yellow is the phase of economies of scale. Why? Because if you see, with the increase in output, my cost per unit is coming down. Okay, I reach an inflection point. What is this inflection point? This inflection point is known as region of constant returns to scale. This region is known as constant returns to scale. This is the inflection point. Why it is known as the inflection point? Because it is a point beyond which the cost per unit will start to rise. So beyond this point, marked in red, the cost per unit start to rise. And this is known as diseconomies of scale. Now, interestingly, when we combine the graph for economies of scale, constant return to scale, and diseconomies of scale, what we get is long run average total cost curve. What we get is long run average total cost curve. Why long run? Because this entire situation of economies of scale, constant returns to scale, and diseconomies of scale cannot happen in short run. So these three phases together cannot come in short run. These three phases will always come in long run. That is why it is a long run average total cost curve. Okay. These three phases can never come in short run. It is always a long run phenomenon. Are we clear? Guys, are we clear? These are some basic things. See, now we come to the important point. Economies of scale. What are the reasons? What are the reasons we will experience economies of scale? Labor specialization. Yes, when you increase the number of output, your labor becomes more specialized. Mass production. Yes, I will take the benefit of mass production, because of which bulk buying of material will happen. Bulk buying of material will happen. So I will get the materials at the lower cost. And last, investment in more efficient equipment and technology. Yes, over here what will happen, my capital is also variable. The kind of investment I can make in capital is also variable, so I can invest in more better machines. What is the reasons for diseconomies of scale? See, increasing bureaucracy and inefficient management. See, both of them eventually hints, so both of them are actually inefficiencies only, with a different nomenclature, either inefficient management or a bureaucratic system. They both are inefficient only, right? So diseconomies of scale primarily comes because of inefficiency. Economies of scale will come because of mass buying or bulk buying, labor becoming better, and you investing in better machines. Guys, are we clear? So with this, yeah. See, this is the explanation of the graph we have seen. Economies of scale, output is increasing, cost is decreasing. Constant return to scale, output is increasing or decreasing, means it is constant. There is no change in cost. Diseconomies of scale, output is increasing, cost is also increasing. Okay. So with this in place, we have covered all the primary aspects of firms and market structure. We have completed demand, we have completed supply. In the next video, we will start with market structures. Till then, happy studying.